Warren Buffett is not only one of the wealthiest individuals on earth, but also stand out as the billionaire with the most frugal habits. This characteristic has been a part of his persona for as long as we can remember. For instance, his breakfast at McDonald's typically costs him around $3.17. When the market experiences a downturn, he opts for economical alternatives. Surprisingly, he continues to reside in the house he bought over 60 years ago, paying a mere $31,500 for it. Nevertheless, amidst all of these thrifty practices, in 1989, Warren Buffett's company invested $6.7 million in purchasing a personal jet airplane. The acquisition showcased a departure from his typically frugal approach. Additionally, in 1952, he made a relatively expensive purchase by buying a Dale Carnegie speaking course.
I was terrified of public speaking, and I went to a Dale Carnegie course.
Although the direct cost may not have been exorbitant, it carried a significant price tag when considering the concept of opportunity cost. However, we will delve into that topic later on. In the same year, 1952, Warren Buffett made an extravagant move by spending 6% of his net worth on a wedding ring. Surprisingly, he goes so far as to refer to this purchase as the best investment he has ever made. This statement highlights his unique perspective on the value and significance of personal relationships and experiences. Despite his outstanding frugality, Buffett recognizes such sentimental investments' profound worth, even if they don't directly contribute to financial returns. Warren Buffett once expressed his sentiment toward purchasing jewelry, stating, "I've never acquired a piece of exquisite craftsmanship that has left me with any semblance of remorse." In his characteristic style, Charlie Munger referred to the jet airplane as the indispensable. Nonetheless, it is evident that Warren Buffett, known as the Oracle of Omaha, believes that there are instances when an investor must be prepared to pay a premium, extending beyond the realm of the stock market. This raises the question, to what extent should an investor embrace frugality? In this video, we will delve into the concept of deferred gratification and distill it into 3 key takeaways. But before we proceed, make sure to hit that subscribe button and enable the notification bell, ensuring you never miss a valuable piece of knowledge. First and foremost, let's delve into why frugality holds significance for an investor. Warren Buffett, renowned for his investment prowess, defines investing as foregoing current consumption to enhance future consumption. Buffett, who recognized the power of compounding early, has always believed that each dollar today could multiply to $10. This assumption, which has proven modest in Buffett's case, highlights how expenses can rapidly accumulate when considering the mathematics behind it. Considering the great stock market returns Warren Buffett has achieved throughout the years, one can't help but speculate on the value of the Dale Carnegie course he purchased at the age of 22 in today's terms. If he had instead invested that money, it would have grown to a staggering $291 million. Yes, you heard that correctly. Indeed, this showcases the power of compound interest at its finest, or potentially at its worst, depending on one's perspective. While it may be unrealistic to anticipate achieving the same level of returns as the Oracle of Omaha, Warren Buffett, let's assume that we could aim for half of that remarkable performance that a young Buffett was able to accomplish. The opportunity cost of purchasing a car in your 20s, even if it's the most affordable model available at current prices, can be substantial. By diverting funds towards a car purchase, you forego the potential returns that could be generated by investing that money instead. Over time, these foregone investment gains can accumulate significantly, highlighting the opportunity cost of choosing to buy a car at a young age. If the money spent on a car in your 20s had instead been invested, the accumulated returns by 30 could have afforded you a significantly more luxurious vehicle. By the time you reached 40, the amount could have been substantial enough to purchase an entire house. And by the time you turned 50, the investment gains could have granted you financial freedom. It's worth noting that Warren Buffett's first rule of investing is to avoid losing money, and his second rule emphasizes the importance of not forgetting the first rule. These principles underscore the significance of making wise financial decisions and considering the long-term consequences of our choices. Overspending is a surefire path to breaking Warren Buffett's first rule of investing. Even without making any mistakes in the stock market, it jeopardizes your financial stability and guarantees a delay in reaching the desired state of financial freedom. Compound interest and its remarkable effects serve as a compelling reason to embrace frugality to some extent. Many investors recognize this principle, so boasting about a high savings rate has become a point of pride in our circles. Charlie Munger once expressed his belief in allocating only 2 or 3 cents out of every dollar he earns towards spending, while saving the remainder. This mindset reflects his commitment to frugality and prioritizing savings to build wealth. What level of financial prudence should an investor strive for? What would be considered a sensible savings rate? Is it 10% of your income or 30%, perhaps more? Ultimately, this decision depends on personal preferences, but I can assist you in assessing your circumstances by sharing some guidelines from Warren Buffett. Charlie Munger, the renowned investor and business partner of Warren Buffett, once shared a valuable insight on the importance of saving money early in life. He stated, "Any money you save before you embark on starting a family or any dollar you save is likely worth $10 later on, simply because of the ability to save it. The ideal time to prioritize savings is during your youth." As previously suggested, the first guideline to remember is that the younger you are, the greater the financial motivation to be frugal becomes. One of the main factors contributing to Warren Buffett's status as the wealthiest investor stems from this early start. He acquired his initial stock at 11, and by his teenage years, he had already accumulated and saved a substantial amount of money. While yesterday may have been the perfect day to begin, today is the next best opportunity. So don't lose heart. Secondly, the extent to which you value a specific activity is a personal choice. Munger suggests it's hard to determine whether it's more advantageous to delay spending $1 on a family trip to Disneyland or any other activity that would bring them an immense joy to have a larger boat, 30-foot instead of 20-foot, when you're 75 years old. In the video introduction, it was revealed that in 1952, Buffett spent 6% of his net worth on a wedding ring, considering it the best investment he has ever made. This statement holds significant weight, given Buffett's track record of successful acquisitions. Furthermore, Buffett would only advise individuals to be cautious and frugal when making purchases that have the potential to yield substantial returns in the future, as demonstrated by his actions, such as spending 1% of his net worth on a Dale Carnegie speaking course in 1952, which, if invested, would have amounted to $291 million today. It may be hard to imagine now, but Warren Buffett faced significant stage fright in the past. He recognized that this fear would hinder his pursuit of wealth, so he invested in overcoming it. The $100 he paid for the course is likely one of his most significant investments. Lastly, the level of frugality one should practice depends on the current state of the market cycle. Buffett stated, if everything is exceptionally inexpensive, such as in '74, you should invest every available dime into equities, and that is precisely what you have endeavored to do. Let's take the current stock market situation as an example. The average 3-year earnings yield of the S&P 500, which measures the earnings generated by companies in that index over the past 3 years relative to their current valuation, stands at 2.9%. As you can see from the image, it is evident that the current value is significantly lower compared to any previous point in history. Take for instance 2008 and 2009, which were notably favorable periods for us investors who were conscious of saving every penny. During that time, the potential gains from abstaining from excessive consumption were more than double what we can expect to receive today. The reason behind this discrepancy lies in the current exorbitant cost of the stock market. Surprisingly, it is more reasonable now to indulge in luxuries like purchasing a Lamborghini than it has ever been before. However, I must emphasize that this is not financial advice, and it's essential to recognize the fundamental principles of investing, often referred to as Rules 1 and 2. If I may offer my speculation, I believe Warren Buffett's ability to maintain frugality despite his vast wealth can be attributed to two factors. His self-worth is not derived from engaging in activities that involve excessive spending, and he does not possess any expensive hobbies that would drain his financial resources. Investors must be mindful of their financial choices, save diligently, and seize investment opportunities. However, it is equally important to acknowledge the value of specific experiences and activities while adopting a prudent approach to personal finances. Thanks for watching. Until next time.